Welcome traders to the Volume Profile course from Elliott Wave Street. I'm Juan Maldonado and it's a pleasure to share with you these concepts. With this course, you are going to completely change the way you are seeing the markets. No matter what market, what time frame, what strategy you like to use, Volume Profile is going to help you to find better trades. At the end of this class, you are going to be able immediately to start using the tool and finding trades, finding entry points, finding value on any market. It is important that you watch this class as many times as possible because there are a lot of concepts that when you watch again the lesson, you are going to be able to understand them better and to install in your system more and more of this fantastic tool. So all the recordings, the tutorial that you need to have to start using the tool with the platform that I recommend, you can find them on elliottwavestreet.com/volumeprofile. Everything free for you on this course, all right? So the recordings for this session that we are live, everything, you are going to find them on this URL. All right, so let's start because we have a lot to cover. A little introduction to the Elliott wave theory because this course is going to mix some Elliott wave with volume profile, but the main tool that we are going to check on this class is volume profile. But we're going to have some examples with Elliott wave as well. So if you are completely new to the Elliott wave theory, don't worry. After this quick intro, you are going to understand the plan of using Elliott wave. So with the Elliott wave theory, mainly we have to watch on the chart where we are in this big cycle, in this cycle that we have here. So a market, because that's the first question when you start doing wave counts. Where should I start? You know, if I'm checking Apple, or if I'm checking the euro, or if I'm checking Bitcoin or the S&P or oil or any market, should I go to the weekly chart and try to find the beginning of a wave one? No, actually the market can start developing the waves on any cycle, anywhere. So for example, if we have a new stock that starts today in the exchange, it could start at the end of this wave 4. And it starts, it burns from there and it starts developing from there, right? So when we find the initial point can be any of these waves, but once we find it, we can project the rest of the move. So mainly, the main message of Elliott wave is that when you have a 5-wave sequence, we call it the impulse. And when you have 3 waves or multiples of 3s, you have corrective waves. And our mission is to find the end of the corrective waves. We're going to see some examples today, of course, but we need to find the end of the corrective waves. This is not an Elliott wave course. The one that we are doing today is a volume profile course. But if you want to learn more about the Elliott wave theory, you can visit our website, elliottwavestreet.com, where we have a fantastic course, and we also have the Members Academy inside the membership if you want to learn deeply Elliott wave. Let's talk about so remember, what we are going to do with Elliott wave is finding the end of the waves in order to find an entry point. All right, that's it. That's simple. The volume profile, this is the volume profile tool, and actually the name volume, the interesting thing here is that the tool doesn't use volume. What? So why we have volume profile if we are not using the volume? That's really weird, right? Well, the issue that we have with volume is that in the stock market, for example, or the futures markets, we have access to the volume. So no problem there, right? But on other markets, such as Forex, cryptos, and others, we don't have access to the volume. Because in the stock exchange, if you're going to buy Apple, you're going to the NASDAQ and you're going to buy it. So NASDAQ knows what you are doing. And then at the end of the day or in real time, they can show the volume. But the issue with the Forex and the cryptos is that we have so many exchanges that they are not connected. So we don't have access to the real volume. So that's an issue, because we don't have volume on these markets, real volume. But the volume profile, what it does is that it brings a calculation of volume, but without using the volume. Because what it means is that the volume profile tool is going to show us the strongest volume where the market or the price spent more time. So let's say that the market spent all this time at this area, so that's going to be the strongest volume. And you see this red line that I have here, that's the strongest volume of the profile. We are going to call this tool the profile, the whole thing, right? And we are going to go like with all the details of each of the components of the tool, right? But remember, this works by checking how much time the price is spent on each level. There is something really important to understand about the markets, and not only for volume profile, and is economics 101, supply and demand. Supply and demand, right? So on supply and demand, what we have is that when the price is going up, right? Price is going up, and it can be any asset, doesn't matter. What is happening with supply? Supply is increasing and demand is decreasing. And we are going to make an example in just a second. But you need to understand that when the market is going up, supply is increasing, demand is decreasing, right? So let's make an example. You want to buy a PC, a Mac, whatever, a PC. Let's say that you want to buy a laptop. And you were checking that laptop on Black Friday, and in the store, they were selling the laptop at $100 during the Black Friday. You say, wow, but I didn't have the money that time. So I'm going to wait. I'm going to buy it later. Then you check the price again 3 weeks later, and it's at the same laptop is at $500. And you say, what? But it was $100 1 week ago. I'm not going to buy it. And then 3 weeks later, you check again the laptop, and it's at the $1,000. And if you want to buy the laptop, you are demand, right? You are demanding the laptop. So less people are going to buy the laptop at $1,000. But if the price starts going down, more people are going to start buying the laptop at $100. So demand is going to increase, but supply is gonna decrease at lower prices. So eventually, if the price is too low, people are going crazy and they are going to buy a lot of units because it's really cheap at $100, and supply, there is no more supply, so price needs to start going higher, right? And the same at the top. If we have the price going higher, going higher, going higher, going higher, You don't want to buy the laptop at $1,000. So demand is going down and supply is going up because sellers, they want to buy at higher prices. They want to sell at higher prices better. But in markets, there is something else. In markets, there is a big issue, especially for the institutional traders. Let's imagine that you are an institutional trader for Goldman Sachs, for JP Morgan, for the Citibank, anything. And your boss that morning comes to your desk and tell you, hey, today I need you to buy 100 million. That's your mission, to buy 100 million of the X, Y, Z asset. This could be a crypto, this could be a stock, this could be an index, anything. It doesn't matter, right? Just your mission is to buy this amount of that asset. And you're a professional trader and you're an institutional trader and you say, okay, sir, sure, I'll do it. And you check the price of that asset, and let's say that you are here at the lowest price of the year and you have to buy this 100 million of that asset. What is going to happen if you go to your platform and you have, of course, a sell and buy buttons, right? The same as retails. So you can press to sell or you can press to buy, and it's going to ask how much. But what happens if with one click you trigger a huge trade like this one? With one click, what is going to happen? Well, if the price is here at the lows, you are not going to have enough supply. Here you are the buyer, here you are the demand. And the supply at that time is really low, right? So you don't have enough supply. Supply at that level is just 10 million. And you want to buy 100 million. So if you make that click, you are going to buy those 10 million that the supply has at that moment. And the price is going to jump. And maybe you are going to create a huge gap depending on the market. And the order is not going to fill completely at this price. At this price, you are going to buy only 10 million. And then it's going to start finding supply because look, supply is increasing. So the system is going to try to find as much as it can to fill this huge order. And at the end, your average price is going to be the worst, or maybe you can push the price higher and you're going to make a huge mess. So imagine institutional traders doing their actions in just one click. The market will be crazy and they will lose a lot of money, right? So what if instead of doing this crazy click, you start looking for accumulation? So the market is going down and you buy not the 100 million, just a fraction of this thing, and the market goes down, but remember, supply is going down, so you are not having enough, right? And then you buy a little bit more, and then the market goes lower, and you buy a little bit more until there is no more supply. And the market goes up, and maybe you still need to have you still need to place 70% of this order. You were able to buy some at the lows, fantastic. But as an institutional trader, you need to go where the highest volume is. And this is the area, the 70% of the profile. We're going to check in a second why the 70%. But here is where you are going to have more supply, more than here. So here at this 70% is where you can complete your action of buying everything. That is why the market goes sideways. Because if the market is going up and it starts going sideways, that's where the institutional guys are doing something. So remember, they can't go with one click in order to fill their orders. They need to do this slowly and split the orders in time. So that's why we have the market bouncing from the lows, because they are trying to buy as much as they can from the lows and in the middle of the box. And then once they complete their orders, the market is going to go in the direction where they make the big buy. So it can go down or it can go up. After the consolidation, of course, it depends on the context. We're going to see how to find the breakout, where is the breakout likely to happen. But here the key point is that they need to buy at this area when the market is sideways, because that's where most supply, if they are buying, or demand, if they are selling, they are going to find. But we as retail traders, we don't need to do that type of thing, because we don't have these huge orders. So actually, we have an advantage, because we can buy, if you buy 10 contracts, 20 contracts, 30 contracts as retail, it's not going to impact the market. So if you see the price here is cheap, you can buy, right? And you can target the point of control. We're going to see what that means in a second, or you can target higher prices, whatever. We're going to see specific examples. But as retail traders, we need to buy at wholesale prices right here. So we buy here and we sell somewhere here. But the area that we want to avoid is the institutional area, that is could be the middle or could be at the top, but the highest volume area, because that's the worst price. If you buy here at the bottom of the market, you can target the point of control. And you have all this area to buy. But once the market crosses the point of control, that is the highest volume, you're not going to do anything. You're not going to buy. You're going to let the price go to the other side and you're going to sell. Sell higher, buy lower. And the same example, of course, the opposite when the market is going up. When the market is going up, we are having high supply, low demand. So if you want to perform as an institutional trader a big thing here, that you have 100 million in the supply and you have to put it in the market, but you only have 10,000 buyers, then you can't put all the order at one click or you are going to collapse the market. So you need to do exactly the same. You need to perform this slowly. So understanding the profile is the same as we have been seeing several times when we were at college, when we were at school, the statistics, basics statistics. So actually what this says is that one standard deviation of the mean is the 68.2%, but actually we average this to the 70% in the volume profile, so it's the same. So actually what we are saying is that 70% of the data is here. 70% of the data is here, right? And in terms of volume, when we use the profile, 70% of the volume is here. And this is the area that you want to avoid. You want to buy at the extremes or sell at the extremes. But how we can bring this bell to the profile on the chart? Well, it's going to look something like this, right? Where the strongest volume will be sometimes at the middle. We are going to see the different formations. This will be the 70% of the data. And remember, if we are going to buy, we're going to buy below. If we're going to sell, we're going to sell below. We're going to sell above. So with this technique, you can start filtering out trades. Let's say that you are seeing the market going down. Yeah, okay, and we are here in the live market. And you are using a moving average crossover system or any system that you like. And you check your chart and it's telling you to sell, right? Because you have a crossover in the EMAs or anything. Well, you are going to filter out the trade because you are always going to buy above, you're going to sell only above point of control. Here you are looking to find a signal to go long. How this could fit in the Elliott wave diagram? Well, look, it's going to look something like this. So we can buy below the point of control that is the strongest volume, that is the point of control. And if you are a great trader, you're gonna buy at the last point when the market was going down. You're gonna buy here because you're aggressive and you have a fantastic way to find out the end of the market. Great. If you are not that great and you need some confirmation, maybe you're going to start buying here once you see some buyers coming or a breakout of the trend line or anything. But below the point of control. And the same for selling. You're going to sell once you are far from the point of control. So don't worry that we are going to see real examples with charts, but it's really important that you understand the concept. We can do the profile to an entire cycle, or we can apply the profile to just a corrective wave, right? So for example, in this case, if in terms of Elliott, I'm looking to find the end of 2, I know that my buying area, according to the profile, is here. Or I can start building strategies. I can say, okay, so once the market goes back to the 70% of the profile, I'm going to buy it. If I don't want to fight against finding the bottom of the market, because that's the subjective part, So I can wait for the price to return here, and I'm going to target the point of control, or I'm going to target the upper side of the profile of the 70%, or I'm going to target this area. But listen, the volume profile is going to tell you if you are at the area of buying or at the area of selling. And then we can add some other tools to validate the idea. We're going to check examples, so don't worry. At the end of this presentation, you are going to have completely clear this tool. Or we can just do the profile of the impulse. So you can do the profile of any leg, any cycle, or the whole cycle, or on any time frame, any area. I call it like doing an X-ray. If you're a doctor and you can do an X-ray of a leg, you can do an X-ray of the chest, right? Any part. Or maybe, I don't know if that's possible, you can do an X-ray like in the airports to the whole body. So it's the same with volume profile. For example, on this one, I'm doing here volume profile only for the wave 4 because I'm finding the end of the wave 4. So I do the profile and I know that this is the area to buy because I can check, I can look to the left, something that already happened, to see where the institutional guys are. And if they are not at the bottom, I have a green light to go long. Let's see more examples now. So in terms of volume profile, this is how it looks in the real world. The total area is all this box here. That's the entire profile. That's the entire profile or total area. The value area is the 70% of the profile. So it will be here. As you can see, is where the price was most traded. That's why it's actually not taking real volume. It's just showing where the market spent more time. That equals to more volume because, as I explained at the beginning, that's where the institutional guys are hiding slowly. And the values at each node, as you can see, I don't use this data, but it's something that is part of the profile, is in terms of volume. Actually, this is the real volume. How many volume we have on the sell side? For example, on this one, let me highlight this one better. So on the sell side, we have 779.4K, and we have on the buy side 561,297K. Which one is bigger? Clearly, the sell side, for example. So we can use it as a contrarian indicator. So we know that if at this level we have more sellers than buyers, market is likely to continue because the majority of traders are wrong, right? So always we need to use this as a contrarian indicator. But these numbers, the numbers, are going to be only exact for the stock market, for the futures market. But for the Forex market, it's impossible, or the cryptos, we're not going to have these numbers. However, it's interesting when we use them, and I'm going to show you an example in a second, that of course we're not going to have real numbers, but it still works, the numbers. Let's have a look. Okay, and the other important thing here, point of control. The point of control is the area where most volume was traded, at this area. Let's have a look at an example on the Forex market. On the Forex market, these numbers are not going to be precise because it's impossible to know the volume of the market. But remember, the volume profile is showing where the prices spent more time. And with that information, we know that is where we have more volume, more transactions, right? We also have gaps on the volume profile where we have little nodes. These are called nodes. Each of these bars are the one node, another node. And usually, the point of control, we can use it as a magnet. So for example, if we are seeing this chart and you are here in the top side of the chart in the real market, one thing that you are not going to do is going to buy the market, right? The first thing that you're going, if you see the chart and you're here live on the market, the first thing you're going to say, okay, I'm not going to buy. The buys were here, below the point of control, or here, or here, or here, or here, whatever, depending on the strategy that we're using. But once the market crosses the point of control, I'm not going to buy anymore. Too late. Too late. So one thing that you are not going to do here, you are not going to buy. Right? That's the first thing you start analyzing. Now, are you going to sell? Well, that's where you can apply your strategy. For example, if you are using, let's say, anything, a trend line. So at the breakout of the trend line, you sell. If you are using a moving average crossover system that you like, the 20, the 50, the 100, whatever, and you have one EMA going like this, and you have the other one crossing, so you sell because that's your signal. What else we can see here? Maybe a double top formation, if you like the chart patterns, because the profile, the volume is telling that the institutional guys were doing their efforts here, and they are not doing the efforts here. So the highest probability is that the market needs to go back to the point of control. And this can be on any time frame. Now, let's have a look what happened here. Well, look, after that, the double top, all the exercise that we did here, the price goes where? To the point of control. And that's where the traders take their profits. So the point of control is a strong resistance or support area. So it acts like a magnet. You know, if you throw a ball and you're here on the ground, let's say that the point of control is the ground, and you are here and you are playing with a ball, and you throw that ball, so it starts going in a parabolic move, and eventually is going back to the ground. And the point of control is that ground. So if you're far from the point of control, you need to sell. Of course, adding something else, as I did. Let's have a look at another example here. This is the Aussie. On the Aussie, we have this profile where most of the volume was traded at this area. Here is the point of control. So in case that you were buying, you are going to buy here, or here, or here, or here. I'm just going crazy, I'm not talking about any strategy here, just going crazy. I'm saying buy below point of control. That's where you need to apply your strategies, right? So let's say that you are using Elliott wave, for example, and you're saying, oh, here is an impulse, and here's a corrective wave. And this is a corrective wave, right? And I can use the failure. It's a technique that I like to use. That is when the price goes below the previous corrective and returns. So here will be a signal to go long, for example. And I can do it because I'm below the point of control, right? And here is where the institutional guys are doing their thing, and then the price explodes to the other side. But if the point of control doesn't move, like in this case, like if the point of control remains at this level, because what could cause that the point of control can move higher? Well, if the price goes up and it starts doing this thing here for a lot of time, more time than the one that the market spent here, is going to move the point of control. And if that happens, you are not going to sell, right? You are not going to sell a market when the institutional traders are buying at higher prices. You are going to sell the market when you see that the institutional traders are below than you are. Let's say that this is the retail price, the institutional price, the fair price, the point of control, the equilibrium. So you want to buy below and you want to sell above. Let's see more examples. Well, here on the Aussie, for example, we have that strong move after that, and it creates another opportunity, right? Let's have a look at the ES. This is the S&P, and again, you can use this one on any market. This is the ES connected to the exchange, to the CME with live data. And this one is the S&P, the CFD. So the CFD is not connected to the exchange, right? So if we compare the future market connected to the exchange with the CFD, look, the profile is the same one. Exactly the same, right? Exactly the same. So here we can demonstrate that if you have access to the real volume, and when you don't have access to the real volume, you are going to finish with the same result. Because volume profile, it's 90%, it can show you in a 90% of effectiveness the real volume. And if we go with the values, right? Look, they are the same, they are different, of course, the values, because these are the real ones connected to the exchange, and this one is just from the broker that provide this CFD that I think is Oanda. The values are different. But here we have more what? We have less sellers and we have more buyers in total of the profile. And here we have what? Less sellers and more buyers. So you can see how this mimic the real volume really close. we don't care if it's exactly the data or not, because this one was calculated by tick volume, and this is the real volume. So the profile is going to be the same, and the values are going to be different, but are going to give the same information, because one is with tick volume and the other one is with real volume. So a CFD can be also compared to what? To the Forex market will be the same, right? To the crypto market is the same. They don't have a centralized exchange. So don't worry about that. And you can make your tests and it's going to be the same. A point of control is, remember, is the strongest volume of the profile. The 70% of the profile is where most volume was traded. You can create profiles of the entire chart or just an area, like I did here. On this example is because I was looking to buy the S&P, and this was a great opportunity that day, so that's why I shared this one. Because look, we have price coming down here strongly. Who wants to buy after these huge red candles? I believe that nobody, right? How you can buy? Yeah, we are below the point of control, but how you can tell that this is the end and right here is the end, right? How you can tell that the price can continue lower? You don't know. These monster candles are scary to go against them, don't you think? But what if we wait to see some buyers? Oh, so they are buying and the price goes down again, far from the point of control, as you can see. And now we have to the left a bullish cycle. So here's where we can buy. We can buy here, for example, using my technique of the failure. So we can buy here. And we can have a minimum target at the point of control. You see how when they break out the point of control, they retest it and the price departs from there? So you are going to buy here. You are not going to buy here. Too late. Always below the point of control. The point of control is extremely important because it's a magnet. It's going to tell you when the market is cheap or when the market is expensive. Let's say that you want to buy a new house and you are looking, you want to find out if right now is a good moment to buy a house. And you make a chart in Excel, for example, and that house today is at $200. And you make the profile and you say, oh, are you crazy? I'm not going to buy my home at above the point of control. And you can do this exercise with anything, with gas prices, with housing, with iPhones, I don't know, with anything that has price and that you can get historic price to find out if it's a good moment or not. So if the house of your dreams costs $200, let's say, and you see this chart, you say, no, I'm not going to buy at retail prices. Only crazy people are going to buy expensive. Oh, I'm not going to do that. I'm gonna wait till I have a discount, at least to the point of control. Well, if I can wait any more time, maybe I have to wait 1 year, 2 years to get here. I can live in rent, right? I can rent a place while this goes down. I'm not going to buy my house until it reaches the point of control, right? Now, if the price of the house starts going sideways here, and then you check the chart 2 months later, and the point of control moves, that will be the new fair price, and the market value will be different. if you have a higher point of control. And then you can say, okay, so if it goes to the lower side of the profile, let's say $200, I'm going to buy it. That can change, that can change. But if it doesn't change, and most of the times it doesn't change, you are going to see some examples, you're going to wait at least to the point of control. So if you are going to buy this house, or this could be a stock, or this could be the S&P or a crypto, you are going to be an excellent trader if you can buy here. You are going to be a great trader if you buy here. You are going to be a good trader if you buy here. You are going to be a relative good trader if you buy here. Here at the point of control, if you buy at the point of control, okay, you are buying at the retail prices, not the best discount, but okay, go for it. Go for it. But if you start buying here, you are a really bad trader. If you are buying here, you are a really, 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 really bad trader. If you buy here, oh my God, I don't have words for the level of bad trader that you're here. And if you buy here, oh my gosh, you really have troubles, like really, you have troubles because you are buying at this market top. You are more than crazy. I don't want to say bad words here, of course, but you know what I mean. You are the worst trader in the world, in the universe. And a lot of people in Bitcoin did that, no? Buying at 60,000. Well, we're going to see that example. All right, so this is the normal distribution. The D shape is called the D shape because it's mainly a D, and it's when the heaviest volume is closer to the middle. This is the normal distribution. And we have the B shape, and is when the price goes down, and we have the strongest volume at the bottom. It's like a bearish flag. So in this case, you need to sell. You need to sell, like if you're seeing the trading range, and you see that the profile is the strongest here, is when you have green light to sell the highs, or the classic range trade that you wait for the price to go outside and then go inside and you sell here, right? That's possible when you are seeing the V shape, because you are seeing that the institutional guys are here. So that's possible. But let's say that you have the strongest volume here, and you can't sell here. You are going to buy. And of course, the opposite will be the P shape. P as Peter. So the P shape, it's the bullish flag. The institutional traders are doing something here. So we wait for the corrective and we go long. The other one is the capital B shape, or double distribution. On the double distribution is when you have the strongest volume here, one belly, and then you have a second belly here. Right? So which one is stronger? The one up here. In case that we have the strongest one here is a sell, right? But because we have the strongest here, that means that the institutional guys are buying at higher prices. So usually it's Elliott wave 4 or something like that, and the price needs to go outside, and once it goes outside the profile is where you can sell it if the profile doesn't move. Now we're going to check some case of studies. The first one is the Bitcoin of 2017, when it went up to $20,000, almost $20,000. I believe you remember that time that everyone was talking about this thing. If on those days, if you go to have a haircut, your styler will tell you, hey, I'm buying Bitcoin. I'm going to be a millionaire. I sell my house. I sell my car. I take a loan and I bought Bitcoin because Bitcoin is going to the moon. And if, now that you know profiles, you're going to tell this guy, oh my God. Well, I have bad news for you, my friend. The fair price is $1,000. And you are buying at $18,000. Yeah, it can go higher. You know, why not? It's possible. It can go from here to 100. Why not? But I'm not going to buy above point of control. In case that I really want to buy, I'm going to draw my 70% of the profile, and at least when the price comes here, if I'm really in a hurry and I don't want to wait for the point of control because the point of control is too low. But at least, you know, I'm not going to buy right there. It's crazy. You are the worst trader if you do that, even if you make money. Because there are two things. When you make a bad decision and it works, you know, if I buy here at 18,000 and I show you this profile and you tell me, no, Bitcoin is going to the moon because I saw that on Twitter. And I say, okay, I respect that, but look at the profile. No, I'm going to buy it, right? And let's say that the Bitcoin goes to the moon from here and goes to 100K in 2 months. And this guy is going to call me and is going to, I told you so. Your profile doesn't work because the market continue higher. Well, it's not the thing, you know. The thing is that if I buy, I'm going to buy at least inside the profile. So look what happened here. It usually works. And this is the daily chart. Also the profile, I draw here the 70% with these red dotted lines. It's the same thing as the weekly. And look what happened next. It went precisely from those highs back to the value area. It didn't went to the point of control here at the 1,000 area, but it went down here. So if it comes down here, then we can say, okay, it's not ideal in terms of market value, but okay, that's better, right? Now, let's see another example here on the Bitcoin, because it's so interesting, you know, this is like something crazy, the Bitcoin, but you can apply the same concepts on any market. So look at the Bitcoin. This is the last move to the 60,000 area. Do you remember that time? That was like April, March this year. And can you imagine the guy who bought Bitcoin here at the top of the last tick at 60,000? That guy should be someone who never in his life saw a chart or have any idea of technical analysis or market valuation, right? But I'm sure a lot of people did that because it was the boom, you know. On those days, if you check the news, all the experts were saying, Bitcoin is going to the moon. Bitcoin is going to 1 million. Oh, look, I bought Bitcoin when it was 30 cents. And now I have this huge amount of money because Bitcoin went to 60,000. Are you going to sell? No, I'm going to hold because this thing is going to the moon. Why? What are the fundamentals to think that it's going there? I don't know what you mean, but I saw that on Twitter, right? On social media, that it's going to the moon. And yeah, probably. Why not, you know? If it went to 60,000, why didn't it went to 40,000 and bounce from there, you know? If that happened, if more people come in, right? This works like a Ponzi scheme, like almost all the markets, but at least the companies have a value. But if more people comes here, well, the price is going to go higher, supply and demand, right? But if you don't bring more people, if you don't bring more demand, and supply remains the same, well, the price needs to go down. So this can continue higher only if you bring more people and more people and more people and more people that hold, right? But what's the thing there? not all the people are going to make the money, because if they all of them sell at the same time, they are going to create a huge gap. So it's difficult. All right. But coming back to the profile. So this is crazy, you know? And this chart, I take this chart from a webinar I did at that time when we were in the market live, and I'm saying exactly the same. So let's be careful. I'm not saying that it's going down. The Elliott wave count said that we're going down, but that's a different story. But something that we're not going to do is buy at these prices. And look at the daily chart. On the daily chart, we have the same thing. The point of control on the daily chart on the Bitcoin was at $10,000. That was the fair price, and the price is at $60,000. And the value area, this is extremely important, it starts from 34,000 area. And you know the rest of the story, right? Poor people. I feel bad, you know. Some people think it's funny for them, and they attack all the people in social media saying, oh, you were wrong, you were right, and it's a battle on the media. But at the end, more than that, those comments of people, if they are right or not, I feel bad for the people who are losing all this money. Some of them, they are still holding the trade. So imagine selling your home, and imagine taking all your life savings and buying Bitcoin here. And now the Bitcoin is here, almost 50%, actually lower, 50%. No, yeah, this is taken from today. 50% from your investment. That's horrible, right? Poor people. I really feel bad for them. All right, so look, the price is still too high on the Bitcoin. This is a profile, and in order to help the Bitcoin, I didn't take the past price because, of course, it's going to lower the profile. So I'm giving a little hand on the profile to the Bitcoin. But actually, a fair price on this Bitcoin would be lower. You know, I believe on the Bitcoin we are going to cross this area. Right? Look at the profile right now. If we do a profile here, clearly is where the price has to spend more time. If we do a profile from here to here, and here we have institutional activity. This is a bearish flag, and at least we need to have another candle here that can go to 20,000 area or lower. Look at this value area down here. Look at the point of control right here. So it can actually revisit the point of control, and if it goes there, and if we have a reversal at that area, it could be interesting. Yeah, poor people. Well, hope they can recover. Good. Dollar Yen. Dollar Yen, this is a real case study. This one was from yesterday. Today is the 14th, and this trade was the 13th. So look, this chart that you see here is the dollar yen, the wave count that I sent to my clients yesterday morning. And I also provide a video explaining the direction of the market. So that morning I said to my clients, okay, traders, I believe this cycle, it's over, and we're going to see the profile in a second. My target is here, the previous low, 109.60 area, right? The previous low. So I'm thinking this is corrective. Remember that with Elliott wave, we need to find out if a cycle is corrective or an impulse. If it's corrective, we are going to the previous low, right? That's simple. And I said to my clients, okay, guys, we are going to sell, but I don't want to sell here at the 20s, right? I want to wait for the price to move a little bit higher, and I'm going to sell it. So I sell the dollar yen here 110.47 at noon. This is a Telegram channel that I have for my clients where I share live trades in order to teach them how to use all these techniques. And this is the profile chart. So actually, when I send the wave count, when I share the wave count, I was thinking that this was the market high. Look that we are really close to the profile. So I said, let's wait for a retrace. During the retrace, I trigger my trade, Oh no, the price during that morning, sorry, the price during that morning made this high, and I said, okay, we are outside the profile. We're outside the profile here, good. So this will be my wave 1, this will be my wave 2. So I sell at the 47. I sell at the 47 and I leave the stop loss at the 75, 30 pips. A little bit less than 30 pips, and the target is here. Well, look what happened. I was chasing the end of the cycle. And look what happened next. So I sell here during this move up, because I already have one validation here, and the price went higher. And I said, okay, fine, look at the profile. Look where we are. We don't have institutional activity here. We don't have it. So we are fine. The stop loss of the trade was at the 75, 110.75. This is a sell trade. And I said, fine. Sometimes it can take us out, no? But say, okay, no problem. It's fine. I'm going to hold it. Look, the point of control where we have it. So we know that this acts like a magnet. And look, the value area, this is a D shape. That's another thing that I want to tell you. When we have a D shape, it's likely to be corrective, right? So the price after that did this beautiful move. I take this screenshot before the class today. Look where we are. So I wasn't able to pick precisely the top, as you can see, right? I wasn't able to, because I started to trigger here. I was finding the end of my Elliott wave 4. But I was at that area that I have the permit to sell, because I can sell here, right? And let's say that I didn't take this trade because it happened during the morning at 3 a.m. I was sleeping, and next morning I see it. Well, a better entry was here at this candle, almost at the same price as I did. This was like another entry, another validation. You see how the price is able to go outside the previous high, right? It breakouts the previous high, but it doesn't find more buyers. It rejects, and look, all these sellers coming down here. So that's another validation. My trade was somewhere here, because I see this validation before, and I take this one. Sometimes we need to try twice or three times. But this is the area. This is the area where we need to use our strategies. I'm not going to buy here, come on, saying that the institutional guys were hitting here, right? I'm not going to buy here. What could be different, you know, to tell, okay, I'm going to buy it? What could be different? Well, let's suppose that the strongest volume was here, and that we have a point of control here. In that case, this was the wave 3, this was the wave 4, and I can buy to write the wave 5. You see the difference? Because the institutional traders were accumulating, reaccumulating here. But we don't have institutional buyers here. So why I'm going to buy is crazy. I need to sell to go back to the point of control. And look, here I'm doing the profile from the low to the high. Only this area, the corrective wave. What happened if I do the profile of this entire area, taking care of this price as well? It's gonna be a completely different analysis? Well, let's have a look. It's the same, right? It's the same. And the point of control, look what happened here. We have some of these institutional guys taking some profits, right? And we are crossing the point of control, but this is a risk-free trade. I already booked a half of my trade out of this trade. And I see potential to come down here again. And I'm keeping the other half of my trade active on this trade on the dollar yen. And this can be made on on the Bitcoin, this can be on the Ethereum, this can be on Apple, this can be on Nvidia, this can be on oil, gold, the S&P, the Nasdaq, the FTSE, the DAX, whatever. The bonds, the dollar index, any futures, is the same thing. That's the beauty of the profile and Elliott wave, because we can use it anywhere. We can use it anywhere. Fantastic traders. So I think we covered a lot. I think it's important that you watch these lessons several times. Extremely important. You can find more about our membership on elliottwavestreet.com/membership. And you can find the recording of this lesson, the introduction to the profile where I teach how to use the tool, on elliottwavestreet.com/VolumeProfile. And we are going to have another lesson tomorrow at the same time, where we are going to check for more examples and more applications. So thank you very much for your time. Have a fantastic rest of your day or night. I'll see you soon. Take care. Bye-bye.